Welcome to the latest restructuring video with myself and Jack Callow on the couch today. How are you doing, Jack?
I'm very well, Luke. How are you today?
I'm very good, thank you. So we're talking solvency?
Yes, specifically solvency reviews.
Solvency review. Okay, so what does that mean exactly?
Well, I think the first thing to say is that, in relation to the series that we're doing, a solvency review is applicable to a business's customers, a business's suppliers, and also the business itself. So depending on where the need is, these are the sort of conversations we will have with customers, suppliers, and obviously business owners. What is a solvency review? Every business will have an accountant. They will put together statutory accounts. Yep. Those accounts will tell the accounting position and a story in themselves, but a solvency review scrutinises that information, challenges that information, and says, "Oh, okay, well, what is the reality here?"
And it's a current review, isn't it, rather than looking back at accounts?
Well, I think that's one of the biggest things
with
statutory accounts, isn't it? It's historic and it's stale and it's a snapshot in time. Management information is hugely important, specifically when you want to conduct a solvency review, because it's what's happening in the here and now, and it's the most up-to-date position you can get your hands on. Now, if that is the stat accounts, that's the stat accounts, but it's going to have limited use. You're definitely looking for better MI in that situation. MI standing for management information, I should say. What is actually going on? What is a property actually worth? What book debts are actually collectible? What stock is there ready to go out the door in the normal course of business, and what's actually just stale and hanging on the shelf? What creditors are due and payable now? Any tax liabilities coming through? Anything that's contingent? Accruals and prepayments are always quite a grey area, and it's just taking the business and its profit and loss capacity to build on that P&L reserve, the income statement, the actual operations, and it's taking the business as a whole and it's saying, where are we? What is the true position? And if it's an insolvent position, obviously there's a huge red flag there. Can we change it? What can we do to improve? Can we build in resilience? If it's a solvent position, excellent. That's an ideal position to have, but what is it that the business wants to do next? What can its current position do to facilitate future ambitions?
So if you're kind of looking at it simplistically, you've got a solvent business. You're in the black effectively, whereas you're insolvent and you're in the red. There's a bit of a problem and a bit of a warning sign.
The question is why? Why are you in that situation, and what's the plan to get out of it? Or what's the ambitions of the business owners? And do they have the solvency within the business to take on the next chapter?
Sure.
I think it's really, really important, and that's the why. That's the why do we care about solvency review, and why would it be of interest? Is it because it displays your options? It gives you a reality check. It tells you what it is your business is actually doing and where it is positioned. And the next question is, well, where do you want to go next?
And why? I mean, I guess why might that be important for directors in particular?
From a solvent position, where did you see the next 5-10 years going? What's the exit path? But on an insolvent position, it comes down to what are your obligations when you are dealing with a business that is failing an insolvency test. And negative balance sheet on an accounting basis is a red flag. But if you're aware that a solvent balance sheet on an accounting basis is actually an insolvent balance sheet on reality check, your duties shift from yourselves, your shareholders, to creditors, and maintaining that you are preserving value and making sure you're taking every step that everyone will get paid, because they have that is the business relationship they have with the company. So it's very, very valuable in those situations, because directors can be looked at quite closely if it spiraled and
Absolutely
came out of control. It's not a spot to be in that you would like to be in.
So I guess the crux of it, the crux of solvency, is around, as a director, understanding where your company is, understanding where the company's going, and also I think being clear on your personal obligations, because like you said, the duties switch. The minute that there's technical insolvency, your duties as director switch to the creditors.
Absolutely.
And not to yourself, certainly, and not to the shareholders. And we see as restructuring and insolvency people that directors can really land themselves in some difficult positions, because the minute that a company is technically insolvent, which actually it's not a particularly difficult test, they're really heavily scrutinised. So I think the point you make about looking at solvency regularly is important. It's about getting advice around solvency as well, and it's about being clear on your options, isn't it?
Yeah, it's regular is a really good word.
Yep.
Consistent, put focus on it, give it attention, And you can build in solvency advantage. You can take steps, relatively simple steps, relatively complicated steps, to make your business more resolute and more solvently based, and that will give you better options and steer you well clear of the troubled waters that you just described quite well.
Absolutely. So I think solvency, it needs to be looked at regularly. You might need help with that. You might need help around your options and your obligations. But I think the last point that you make, Jack, around it's about becoming more resilient and actually about becoming more solvent and strengthening your business. And that's where the likes of sort of restructuring people fit into that. So yeah, brilliant. I think some great points around solvency and the importance of solvency. Thank you very much, Jack.
Thank you, Luke.
Very insightful, and thank you for watching.